Peter, welcome back. I want to jump straight in today with all these government changes that are going on, all the fun that we've had within the government. Can you briefly explain to us, what limited company property investors will now have to pay in the form of corporation tax? Has that changed, or what are the changes?
Well, Justin, yes, it has changed, and it's changed back, and it's changed again. So now, and whatever date we're on today, what is the date today? The end of October.
Yeah.
It looks likely that going forwards, there could be a maximum rate of tax of 25%. In the past, if we went backwards, this maximum rate of corporation tax was 19%, but potentially now that could get up to 25%. For most buy-to-let owners, it's not going to affect them. For most buy-to-let portfolios, there isn't £50,000 worth of profit in a year.
Right.
And if the profits are below 50,000, the maximum rate is 19%, going backwards and going forwards. But if you've got a larger portfolio with larger profits, then potentially by the time you've got £250,000 worth of profit in a year, you could be paying 25% corporation tax, so 6% more.
With people that are directors of limited companies, is there any changes to the dividend tax and what they'll be paying off the back of that as well?
Yeah, there are some changes to dividend tax that actually didn't change during the mini budgets. They stayed the same. This year, we're paying an extra 1.5% in dividend tax. So if you're a basic rate taxpayer in the past, you paid 7.5% more tax on your dividends.
Yeah.
Now that's 9%. If you're a higher rate taxpayer, you were paying an extra 32.5% in the past.
Yeah.
It's now 34%. Those rules haven't changed across this year. They're all in for this year. So yeah, if you take dividends out of your buy-to-let company, at the moment, it's a little bit more expensive in terms of personal tax.
Okay. And of course, anyone that just reinvests the profit, they won't need to worry about that.
Yeah.
It's purely for people.
This is only if you take the money out. There is that small dividend allowance of £2,000 that you can take out tax-free.
And that's remained exactly the same. Okay. Do you foresee that remaining as £2,000? Because I know they've changed that in the past.
I don't think they'll change that, because that's actually, it's not for buy-to-lets or those sorts of companies. It's often for people who've built up portfolios of shares or small portfolios of shares, and they don't want to get them to do a tax return because you had 100 British Gas shares or something like that.
Yeah, okay. And for anyone that's investing in their personal name, have there been any effects to the way they invest or the way they pay tax, should I say?
In terms of their personal name, no, the taxes are the same. The 19% tax has gone, it's still 20%. So taxes are pretty much the same if it's in your personal name.
Okay, perfect, good. And the main reason for, obviously catching up with you today, doing a new video, is that there are some changes coming to property investors, or to limited companies, should I say. As of April 2024, the tax rules will be changing. I don't know if that's just limited companies or personal names as well.
It's actually not limited companies.
Right, it's the other way around.
So it's just people who own property in their own name, or jointly with husband and wife, or brothers and sister. Anyone that owns property in their own name are going to be subject to making tax digital for income tax self-assessment.
Yes.
And what that means, that in April 2024, you will no longer send in a self-assessment tax return once a year. You'll have to send in to HMRC from April 2024 a digital copy of your records once every quarter.
Right.
So it's going to mean that there's going to be 4 returns across the year, and 1 final return to correct up any mistakes you made on the previous 4. So 5 returns rather than 1.
Right.
It can't just be done by putting some numbers on your self-assessment tax return. You've got to have a digital record in the background. That most likely means a little bit of software to be able to record down the rental income and the expenses. And that needs to file automatically into HMRC. So that's going to happen in April 2024, unless the government delay the implementation.
Which they have done previously?
But I don't think, their plan isn't to delay beyond April 2024.
Yeah.
And I think anyone who is looking at it ought to get ready from now.
Think about it.
Think about it now, and it will come in. If it gets delayed by a year, it'll still come in. So you may as well get ready for it now. There are loads and loads of benefits in terms of having this information. You much better know what your tax liabilities are more often. So there's lots of benefits for landlords in having it, as well as a bit of hassle.
And for someone like me, who obviously I work with yourself, with PJCO and the team that you have here, at the moment, obviously I get to the end of the year, you help me complete the tax return. How does that differ? How does that change? Is it just more regular, or is there anything else I'll have to do in addition?
Yeah, so for most individuals that own property in their own name or jointly, at the moment, a lot of those people will keep a spreadsheet of your rental every month and your expenses every month and your letting agent's statement every month, and maybe hand that in to us in a spreadsheet or all the paper together, and we'll produce the return from there. Going forwards, and we've already started this process, going forwards, we're going to have to put those people onto a little bit of accounting software, specifically designed for landlords, the one we're using, that will link to your bank account. So you'll have to have one bank account, recording, getting your rents in and paying expenses out of, link into that bank account, and that will then produce a statement of, this is how much rent I've had in the quarter, this is how much I've paid out to letting agents fees, this is how much mortgage interest I've paid. It'll link to all those things so that record can be passed on to HMRC.
Interesting. And obviously, as I've just learned, that's for personal name.
This is for people, owning property personally, owning property jointly, husband and wife, brother and sister. It's anyone that owns a property personally. It doesn't at the moment apply to limited companies with buy-to-lets inside limited companies. Okay. That's coming later.
That's good to know. That's good. Peace of mind there. And I think now's possibly even a good time to add this question in, which I know is something we were going to cover, and that is, can you move a property from, if anyone that's sitting and listening to this and they've always thought about moving a property from personal name to limited company, and maybe this is the kicker that finally pushes them to do it. Is it easy to do, and can it be done?
It can be done. In fact, it can be done very easily, but it can't be done very easily without a tax liability. So the general rule will be, if you've got a property in your own name and you want to move it into a limited company, you're going to have capital gains tax to pay on the difference between what you paid for that property and the market value when you move it into the limited company. So that could be capital gains tax at up to 28%. On that. And you'll also have the company will have stamp duty to pay when it buys the property off you. So it can be done, but you've got capital gains tax and stamp duty. There are a few long ways around not having to pay that capital gains tax and stamp duty, but they're not short fixes. You'll see lots of things on the internet with people saying you can do this quickly and easily. It isn't. In general, if you want to consider that, first of all, in most cases, well, in fact, in all cases, you'd have to be a partnership in the first place. So the property would have to be owned by two people, at least two people. It would have had to have carried on as a partnership trading. So normally you'd be saying, well, I need 3-5 properties like this, and will have needed to have done that for a few years, probably 3 or 4 years. And then at that point, it's potentially possible to move those properties into a company without capital gains tax and potentially without stamp duty. But to do that, you need to have all the right paperwork in place. So I think if you were looking at doing that, you need someone that has got a proven track record of being able to do this. Don't give you a shortcut route and copies what somebody else did. Someone that can show you this is how you do it and this is how you comply with HMRC. But potentially that can be done. But I think it needs to go to specialists to do it.
Now, this is a fairly generic question I've just thought of the back of that, and that is, for anyone, or in a lot of circumstances, I talk to investors and they'll say, I've got 2 or 3 buy-to-lets in my personal name, used to be efficient, now it no longer is. It almost put me off investing. I've heard that a lot of times. Do you find that more often than not, they're better to leave those properties in their personal name and start any future properties buying them in a limited company, or are those people in those circumstances, are they normally better to start switching them? Now, I know it depends on their tax liability.
Depends on the tax liability, doesn't it? If you've got an enormous great tax liability, then it's not going to make sense to switch them.
Okay.
In most cases, I would say that what I can't do, and no one can tell you, is what the tax rules are going to be in the future. But probably if you own some properties jointly or in your own name, and some properties inside a company, in 20 or 30 years' time, when you want to cash in on this portfolio, you're going to have a bit more choice. It might be in 20 or 30 years' time that properties owned in your own name are cheaper to get rid of than properties owned inside a company. And then you'd have the choice, well, I could get rid of those, not the ones inside the company. It might be the other way around. So I don't know, but I think if you wanted to spread your risk, you'd probably own one or two in your own name and your whole portfolio, your other 20 inside a company.
So maybe if someone didn't have a huge tax liability on the ones in the personal name, you might think about just holding them there, continue investing maybe in a limited company going forward, but don't make any rash decisions about selling those and transferring them.
Yeah, you really have to work out how much it's going to cost, how long it's going to take you to get a return on moving them from your own name into a company, especially if you're paying capital gains tax and stamp duty.
Fab. Okay, brilliant. Well, Peter, thank you as always for coming on the channel and answering these questions that investors have. We'll be doing another one very shortly, so it'd be great to have you back on then.
Good. Cheers, Justin.